Welcome to Kaizen Time, part of the Blood, Sweat, and Business podcast, where we provide constant improvement to businesses through timely, actionable financial solutions. Do you want answers to your financial questions? Email us at bsp@kaizencpas.com. I'm your host, Mark Valesky. Now let's get started. Welcome to another episode of Kaizen Time. I'm joined by Clay Hamlin here, a partner at the firm. How you doing, Clay?
Great, Mark. Great to be here.
I am really interested in talking about transitioning a small business. It can go a few different ways. It could go private equity. It could go to internal employees. It can go to a family member. What are the most common ways that we're seeing kind of right now?
Two primary. One is, and the most common is within a family transition. Mm-hmm. And then the other one is selling to an outside party. And those have much different scenarios, like how you build up to those things and what happens after those transitions occur.
Well, let's start with private equity, because I feel like that's going to be the most complicated and difficult to tackle, right?
Yes, true.
Okay.
Those are less common, but we did see probably between half a dozen and a dozen what's called PE, private equity transactions in 2023. They tend to be for clients that are ranging in about 5 to 15 million in revenue and nicely profitable each year. Mm-hmm. And in each case, they sold for quite a bit of money. 10 to 20 million was kind of in that range.
Oh, that's great. That's like a 4X, right? What they're bringing in?
Yeah, at least that.
That's great.
So those transitions, though, tend to be trickier because private equity is typically buying either all or more commonly a portion of the business, not the whole thing. And then they require the owner to stay on for a period of time because let's say they buy 40% of your company or 60% of your company. They're not buying the whole thing. And then oftentimes they don't have the people to staff it. So they're still expecting the owner to run it.
Okay.
It's just the owner is now, or the former owner, mm-hmm. is now working for that PE. They're sort of under the thumb, if you will, of that PE company. And the PE company is looking for how can we maximize the value of this transaction over, say, a 7-year period. So how can they, what can this company do that they've just acquired, ramp up their profitability and or size to the max in 7 years so that PE company can sell it.
So is that kind of how these private equity companies are working? They look at it, they're like, we're going to purchase it or whatever, and then bring it up even more to sell to somebody else. That's kind of their mindset?
Yes. We did have one where the PE company said, we're more of sort of the Warren Buffett way of doing things, which is we're going to buy and hold for a long time. That's rare, though. PE is typically, they're looking to get out to 5 to 7 years, make their return, sell it again, try and do this with another PE company that wants to jump in and buy it then.
Would you say there are certain like PEs that are certain tiers, like one that works closer in like the 5 to 15 million, then there's one that goes even higher? Or is that not how it really works?
They're not usually interested in what might be considered a micro business from their standpoint, which is less than 5. Mm-hmm.
Once they hit that 5 million plus, that's when they PE starts to become interested. Yeah. Okay.
And there's quite a bit of PE activity at about, say, 10 to 15 million. It's really ramping up. From the PE company's standpoint, what's going on out there, there's not a lot of great places to invest money. For a long time, bank accounts were 0.5%. Right now, maybe you can get 4-ish. The stock market doing okay. But a lot of small companies are making, say, a 20 to 25% net profit margin. And they're looking at this going, this is really great.
That's a better return than leaving money in the bank, right? Way better.
And so they're like, but there's more risk to it. And it's even better oftentimes than what they can get in the general stock market. Mm-hmm. So they're looking at this going, this is actually a pretty good bet if this company will continue to perform like it has.
Okay.
So that's kind of where PE money is saying, hey, maybe even in the $5 to $15 million space, we can make some good money and then jump out and make another kick when we sell.
Give me a quick overview of what the process would look like. I remember you telling me there are more lawyers involved, more paperwork.
Oh, yeah, way more, way more. So there's probably a 6-month dance of where the PE company starts to show interest. What they're oftentimes looking for is repeat business, and they'll ask you for more data than any outside buyer ever will. They'll ask you for, like, by customer, last 5 years, how much have you, what's your revenue by customer over the last 5 years? Where do you think you could gain some additional revenue? These are never, like, bad questions to ask. It's just they ask them, and hardly any other buyer does that.
Okay.
But they ask really detailed questions, and you better be prepared for a long list of things.
I was about
to give
to say
them.
that's kind of not the questions that the owner may just have off the top of their head, right?
Very rarely does an owner have that.
And would you say this is probably the part where, like, our firm really kind of is able to help them because we collect all that data and we're kind of able to provide that?
In many cases, not in all cases, but in many cases, we can definitely reduce that load of what an owner has to go dig up. So, for example, if the owner is using QuickBooks, for example,
Sure.
we can go into the QuickBooks and dig up that kind of information, and we've done that for clients.
Okay.
Where PE, but it's a lot more than just that. I mean, the PE companies, they might have a 10-page, single space questionnaire of stuff, and you look at that and you're like, is this worth it? Right?
It's almost like a project, right? Like it's its own assignment that you really will be working on for months.
Yeah.
So with that said, let's move over to a more simple transition, which would be to an internal employee, a family member. What's that like? Obviously, it's not a packet of paper.
Right. The easiest one it was the family transition, although from a paperwork standpoint, although maybe from a emotional standpoint, it's not exactly the easiest.
Yeah.
So when you go PE, you're oftentimes getting a large premium in comparison to what you would get transitioning internally, especially to a family member.
Sure.
So there's some emotion around that. Mm-hmm. Oftentimes, part or all of the amount is gifted. Mm-hmm. And so the family doesn't need to prepare for that transition by minimizing or maximizing their tax, depending upon how things go. So, like for PE, you want to maximize you want to look, it's sort of like going on a date, right? You're going to look as good as you can, of course, from a tax perspective. Mm-hmm. When you're doing an internal transition, especially with family, you don't need to do that. You can keep minimizing your taxes as best as you can, because internal transitions like that are not looking for, hey, what's my return in 7 years? How much will I be able to sell this company for in 7 years? That rarely comes up.
That's not really part of the conversation.
It's not,
especially because the people in the family or even internal employees kind of already aware of everything. They don't have to ask those kinds of questions like, oh, well, who are your top clients? How are these people already know?
And there's a much different toned things. So like the PE company that's all about money.
It is. They are a business.
All
and they
about money. Yeah.
Generate more business.
Internally, it's actually money is maybe second or third. We're talking about continuity of business. This business has been in the family. We're going to keep it in the family. We have these customers, clients, whatever, that we really like. Mm-hmm. We're going to keep servicing them well. There's a lot more things that go from an emotional standpoint that go into that transaction than PE or even selling to a trusted internal employee. A trusted internal employee does understand the business better than, say, PE. PE is asking all sorts of questions.
Yep.
But for some reason, the trusted internal employee really ought to ask more questions, but they rarely do. They just sort of assume that they know what it is, and they don't really.
let me ask you this: is it probably? Oh, I'll just take a stab. Private equity does this all the time, so they know the questions to ask.
Yes.
The trusted employee is probably just is a worker there, right?
Yes.
They wouldn't know the questions to ask because they're not in the position to kind of even know what those questions were to begin with.
Correct.
Okay.
Yep. And then the sort of the fourth way, right, is you sell to just a general outside party, not
a big company,
not a key employee or PE company or something.
Okay.
That also is very common. The biggest mistake that most business owners make is they do a sort of DIY. I'm going to sell this thing myself, right? Do it yourself. And it's oftentimes their first time selling a business. Mm-hmm. And so they don't really know like how to do this, but they just sort of talk to some people. Hey, might you be interested? And they oftentimes will leave substantial money on the table simply because they don't know how to do this. Mm-hmm. I would definitely recommend hiring a business broker or someone that knows what they're doing. We do this a little bit for some clients, help them sort of from a brokerage standpoint, but we're not professional brokers.
Yep.
But we can help clients. If it's a bigger business, I would definitely get someone who's a professional. This is what they do for a living. Mm-hmm. They know how to market it. Mm-hmm. They know how to find people. It's not easy in the small business space to find someone who was willing to buy this business. It's not like you can just post something on
a Facebook marketplace.
Yeah,
right?
Yeah, I mean, right. Yeah.
Well, and I think we've even had that conversation before where there are profitable businesses and, it's time for the owners to quit, retire, move to Florida, whatever it is.
Right.
And then they just like, well, we don't have a buyer. And then they just shut the whole thing down.
Yes.
So the value of these businesses is really determined by the buyer. If there's no buyer, then there's the value there. So you're right. These kind of brokers would be really helpful to find your, I guess, ideal client, right?
Yep. The other thing too is, when a business owner starts to get to the point where they want to sell, there's this tension between marketing, which is putting yourself out there saying, hey, I'm available for sale. Mm-hmm. And hey, if I tell people I'm available for sale, my customers are going to be like, well, this guy's on us or person's on it.
Yep.
Yeah, I need to find somebody else.
Mm-hmm. Yep. No, I see where you're going.
And so businesses can lose value very quickly if everybody knows, hey, this business is up for sale. And it might even just shut down. So who really knows? So it's better just to find somebody else than it is to go and advertise. And a business broker is able to negotiate those waters better because they're not the owner. They know how to sign these non-disclosure agreements and all these other things that business owners often feel uncomfortable with.
That makes a lot of sense. And kind of even just what we do with our own businesses, we're professionals. This is what we do. We should be able to do it faster, easier, and take out that stress.
Correct.
So I get that.
Yep.
Clay, is there anything else you want to add for transitioning a business? I know we've kind of talked about how to prepare it on a previous podcast. Yep. Anything else that you feel like, hey, we really need to cover?
Because it is such an important financial milestone for business owners, I would warn against DIYing this thing, to try and do it yourself. You're going to need an attorney, you're going to need an accountant, and you're probably going to need a broker. And when you spend the money and do it right, you oftentimes get a much better result than if you just launch that baby yourself, unless you are going to do this with a family member. Mm-hmm. There, it's much less formal. The dollars typically aren't as big. And you can negotiate things even after a deal, like, oh, that didn't work, let's change the agreement to say this. You're selling to an outside party. It's a once and done. They usually will not say, oh, sure, let's redo that agreement.
Yeah, right. No, this is done. You signed it right there.
Yeah, we forgot about that. That doesn't usually work.
One one last thing that I want to ask is, how much time should we be preparing? We say, hey, I'm thinking of shutting down the business again, retiring, going wherever.
Yep.
How much time do you think should be set ahead for the planning and preparation to the finally, it's your last day?
Yeah, I would say at least 3 years. And the reason is, if you end up selling to an outside party, you need to show good profits.
Gotcha.
Because that's what sells, right? And so oftentimes business owners are doing everything they can to minimize their profitability because it minimizes their tax.
Okay.
And that's great, except for in those last 3 years, if you're in a beauty pageant, you were up there on the stage in a bag of rags, you're probably not going to win, right?
Yeah.
And so, if that's what you want, you want to walk around in a bag of rags because you don't want to pay taxes, and I get that. Believe me, if there's someone in this room who understands that, I do get it. But it doesn't sell your business, and so that's why the planning needs to occur 3 years in advance.
And so you set yourself on that trajectory to show that profitability, to really sell for what you want to do.
Yes.
That is phenomenal advice. Thank you very much, Clay.
Yeah. Thanks, Mark.
You've been listening to Kaizen Time, part of the Blood, Sweat, and Business podcast. If you like what you heard, subscribe and leave a 5-star review. This podcast has been brought to you by Kaizen CPAs Plus Advisors, providing advisory and accounting services to help you grow your business. Learn more at kaizencpas.com or email us at bsb@kaizencpas.com.